Terrific. So thank you again, Marty. Thank you, Esner Amper, and thank you for everybody joining us today. So today is our real estate investment forum. You're right. We have a nice West Coast group. We've got three of our panelists right there in front of me, and then we've got the three of us also on the line. So what are we going to cover today? Our discussion topics are right what I think family offices and pension plans are looking for. We're going to talk about the interest rate environment. We're going to talk about key real estate predictions and what's taking place there. We're going to talk about property sectors and how to attract capital. A lot of people on this panel have JV experience and they're putting funds together. So how are we going to do that? We're going to talk about construction lending trends, what's taking place. We all have family offices and pension plans that are in that area. And then finally, we're going to talk about future interest rate expectations. So we're going to cover a lot of good ground. We've got five great people. For myself, my name is Matthew Kessler. I own my own company, Kessler Global Partners. My primary focus is on commercial real estate. I have a sourcing and debt team, and we are looking for priority debt for family offices, pension plans, and those that are doing JVs. And then our portal where we go out and find our debt is the obvious: banks, family offices, private equity funds, hedge funds, and the SBA. So I'm going to ask all of our panelists to give a nice, tight, brief overview of themselves as we go through. So I'm going to ask my first guest, which is going to be Larry, Dr. Souza, because Larry, we've got WTI today at $122. We've got the S&P down 14, but for the very first time, we've got the long-term 10-year Treasury for the fifth time this year has hit 3%. So what I really want you to do, Larry, is set the table for us and talk a little bit about what you see in terms of rising interest rates and what does this mean for commercial real estate. Larry, go ahead.
Sure. Well, I think the Fed's been pretty clear, on what the interest rate path is going to be. They've already told us that they were going to raise interest rates by 50 basis points on the short end and continue that path over the next 3 to 4 months. So they've already basically told us that, short-term interest rates will be rising. What's interesting is over the last 2 to 3 weeks is inflation expectations on the long end have actually started to come down. That basically means is if short-term interest rates are going up and long-term interest rates are going down, real rates are actually going up. That would be my biggest concern from an equity ownership standpoint as the real rate starts to rise. That stock prices will continue to go down. I think the underlying fundamentals in the commercial real estate market, I don't believe that there's really a correlation between cap rates and interest rates. Cap rates have basically compressed across all of the property sectors. And I think that will continue to hold because there's so much capital that's pent up to get into real estate because there's attractive spreads on the cap rates over the 10-year Treasury. There's a wall of capital looking to get in, and basically the underlying fundamentals for most of the property sectors, even office, look positive and will probably continue unless we fall into a recession in the next 24 months, which we probably will. But if the Fed moves quick enough and the underlying fundamentals stay relatively solid, it'll be a technical recession and nothing like we saw during COVID or the 09 or even probably the 01 or the 91, 93 recession.
So Larry, let me sort of jump in here because, you have a real estate background, a financial background, you're an investment economist, you're an advisor, you're a broker. I mean, you get to wear so many hats. So having you here today is so important. So I really appreciate it. So you said something that was interesting. There's a wall of money out there. If there really is a wall of money out there, Ken Nitzberg is the chairman and CEO at Devon Self-Storage. He put the company together in 1998. They've got 87 facilities today. So, all of us were talking earlier in the week a few times. So Ken, let me ask you to address the fact that self-storage is profitable. It's recession-resistant option, most importantly. Explain why this wall of money from pension plans and family offices are attracted to storage.
I think they're attracted to our sector for a couple of reasons. The main one being over the last 30 years, it has proven to be fairly resistant to recession. Nothing's recession proof except, like I said the other day in our call, maybe beer. That's about it. Times are bad. They still sell plenty of beer for Budweiser. But we tend to perform well in good years, and we perform okay in bad years. When you string a bunch of those together, we beat most everybody. And if you look at the NAREIT averages for all the different sectors, and I really don't like REITs because when you make real estate tradable every second, you defeat a lot of its inherent purposes, but that's the only yardstick we have. And if you look at the NAREIT results by category, there are some 30 plus different categories of real estate, and any 5, 10, 15, 20-year period, storage is always number one or number two, always. We're like the tortoise and the hare in the race. You know, we rarely win the race, but we always finish. So it's been a very stable business with good returns and highly diversified. I mean, I've got, like you said, we have 88 stores today around America, but I've got 40,000 tenants on 30-day rental agreements. So no one tenant going upside down is going to, you know, bust our chops, as it were. But you do have to have your systems in place so that you can deal with 40,000 individual tenants.
So let me ask you a question here. I mean, if I'm a family office and I'm looking at storage, what % of my portfolio should really be in a hard asset like storage, you know, whether it's regional or national? What do you say to your pension plans in terms of asset allocation, or your family offices? What do you say to them?
Oh, it should be 100%, obviously, Matt.
There we go.
Okay, that's a silly question. No, it's hard to say it should be 3% or 5% or 20%. Those are all the pension consultants I deal with, who are the people that,
sure,
you know, have as I like to say, a manual with 1,000 new sex positions and no date. So it really depends on their total overall assets. What are they looking for, income or appreciation? We have clients in the pension world who tend to want to hold for 4 to 6 years. They're IRR driven, and time becomes your enemy. You get past much in the way of 5 years, and our family offices hold forever. They just refinance every 6, 7 years because they have tax consequences. Whereas the pension funds, you say, what about your taxes? And they go, huh, what's that?
Right. Well,
it's not a consideration in the process.
Understood. So let me pivot. I'm going to pivot over to Jeffrey Leone. Jeffrey is the managing member at HLA Ventures. HLA Ventures is located obviously in San Rafael, California. You know, he has some great ideas about what's going on in terms of joint venture, you know, being a multifamily developer advisor, as well as a shopping center developer advisor. He's got his hand on a lot of triggers. So Jeff, let me ask you a question. I mean, in your JV fund, you recently purchased an asset, you know, at $7 million, you sold it at 25 at a cap at 3.5. Can that continue as we talk about this wall of money coming in?
Well, it's, you know, Matthew, it's an interesting question. You know, that was a deal that we bought in 2014. And we were lucky enough to buy it at 75% of replacement cost with an in-place cap rate of 6. Fortunately, as Larry pointed out, you know, rates have gone up, or I should say rental rates have gone up, and we were able to refinance about 4 years later, all our investors' money out. And then 5 years later, we sold it to a trade buyer. I still think self-storage is a great sector to be in. I think in downtimes, people, they downsize, and in better times, they put stuff in storage and buy new things. So I think it's a solid sector. We also invest in other verticals, including retail, office, and multifamily. And you know, I think you touched on interest rates. I think that it certainly hasn't slowed down any of the sectors we invest in. I think it might as the 10 years continues to tick up, because our borrowing is predicated on the 10-year interest rate.
Well, how do we make this a little bit more efficient? I know you and I talked earlier in the week, and we talked about investor portals, that investor portals make, you know, sort of this private capital markets more efficient, transparent. How can family offices and pension plans today take advantage of these investor portals that are available to all of us?
It's a good question. I think when we started raising capital back in the late 90s, I mean, we, you know, like everyone else, we faxed and PDF'd documents, subscription agreements and K1s, and I think people lost them, and it was a mess. But in the past few years, we moved to a customer relationship management software solution that basically organizes investors' account through a customizable database. It's a cloud-based software. I mean, there's a number of them out there, but it allows us to do partnership accounting distributions and the like. And it also allows us to optimize our fundraising effectiveness because it saves time, and also saves time for the investors because they can access their accounts from multiple devices. Their accountants can optimize it, and it's got the highest level of encryption. So information is totally safe.
Wow, that's very fascinating. So let me pivot again over to Deborah Mangan. Deborah is at Athena Investment Group. She works with family offices. She works with private equity firms. She's a developer. She's both on the fundraising side for early stage capital raises for, say, tech companies, and she's on the mortgage side finding money for developers like myself. So Deborah, let's stick to family offices for a second. Are family offices a good source of ground up construction for bridge loans?
Yes, absolutely. Private real estate lending and debt funds have really blossomed rapidly as an alternative investment in recent years. And it's a very desirable investment vehicle for family offices. They provide investors the opportunity for high returns and risk-adjusted returns with prudent leveraging and income and portfolio diversification. So since 2008, there have been hundreds of new entrants into the alternative lending space. And one of the fastest growing areas has been debt funds. And in particular, real estate debt funds. And this includes funds for construction financing. So in recent years, I have become an expert with large scale construction financing and bridge financing. And so I work with I've been working with an incredible international family office headquartered in Ottawa, Canada, and the head of the family office.
The family office is located in Canada, and we've got 10-year rates here in the U.S., for the fifth time in a row, closed at over 3%. How does that work for them in terms of, the translation in interest rates between U.S. and Canada?
I can't speak on what they do internally in terms of Canadian, what's, that kind of dynamic. But I was going to say that the head of the family office is located in North Carolina. And to go back to your original question there, so there's in fact a PwC analysts project anywhere from $4.2 to $5.5 trillion between 2021 and 2025 will go towards the expansion of primarily 4 illiquid assets of private equity, and that's including real estate and private credit. So even in the worst case scenario of a prolonged post-COVID environment, the projections look really positive in growth of almost 50% up to year 2025.
Okay, so we're now stepping over into Larry's shoes. So let's hang on to the economics part for a second. And let me move over to Jeff Lerman. Jeff and I have known each other, obviously for a while. I think what I like about him, and, I've been on panels with him before, is that he's really a real estate investor's lawyer. He keeps everybody in their lane. He keeps everybody going in the right direction. And he's also a principal, and he's also part of a family office. So, being part of his sphere, I think, is just so helpful to an investor that is looking to go into real estate, but wants to make sure legally that they're doing all the right things. So, Jeffrey, let me ask you a quick question about JVs and what most families don't know, but keep it short, keep it simple. Also, give us a little bit about your background would be helpful.
We thank you for that introduction. And we help investors nationwide with their transactions, such as entity formation, syndication, joint venture.
Hey, Jeff, it's a little bit loud. So you have to do the exact opposite of Matt and turn down a little bit.
Well, let me give it a shot here.
Good luck.
Let's see. Hold on. Is that any better?
Yes, a little bit.
Wow. Okay. Hold on one second.
It's okay. Keep going.
Sorry. Hold on.
Good guy.
Gotta love technology.
Yeah.
Always still.
Go right ahead, Jeff.
Yeah. Hold on one second. I had my notes up here, and
Just talk
Okay, so
softly.
we're
You're
talking
fine.
about family offices, what they don't know. So help us with JVs and what they don't know in family offices.
right. So, and we usually talk about this for an hour at a time. But in any event, so a joint venture is let's first define that. Joint venture is the coming together of two or more people for a common business purpose, and family offices should be taking a look at this because, in my opinion, joint ventures are the cheapest, easiest, fastest, and safest way to get deals done. And if you're not already doing this, this is something that you should be considering. And we can do me a favor. Go to somebody else because I want to pull something up here and I want to share it with everybody. And I have to pull it up because of what just happened. So come back to me in a minute.
No problem at all. So Ken, let me go back to you because we all love storage. We all understand storage. You know, we just came out of a 2-year pandemic, which was a black swan event that nobody's foresee coming in any shape or form. And I've decided not to go back to work. And now I'm living at home and I've taken the third or fourth bedroom and I've turned it into an office. I've gotten rid of everything that was in that room and I put it in one of your centers. What's the future look like for that guy who has put, you know, his belongings in there for the last 18 to 24 months? Do you think he's staying at home? What happens to storage and how do you predict your sort of cash flow going forward as a result of these type of new COVID renters?
Well, just in general terms, the best things ever happened to our industry in the last 30 years has been the 2.5 years of the pandemic. It's been, you know, when it first hit in early February, March of 2020, we were all scared to death that it was, you know, the Chicken Little was an optimist and we were going to get crushed. And very quickly, we found out it was just the opposite because, as you said, Matt, people are cleaning out that extra bedroom to make it an office. I mean, my daughter works here in downtown San Francisco at the Gap and has for 15 years. She works out of a bedroom of her home now and hasn't been in her office in 2.5 years. And they told her, don't even think about coming back. She's on Zoom all day long, like we are right now. And I think what's happened is we've changed some of the culture. People who never used our product before now do. And it takes a lot to change that culture one way or the other. The other important thing it did for us is prior to the pandemic, our average tenancy was about 10 to 14 months before the tenant turned. These are temporary uses. We don't have leases. We have rental agreements. They're evergreen. They renew every 30 days unless either party cancels it. Well, what we're finding now is tenants are staying 20 to 24 months. And the number of new tenants coming in has also gone up as you cleaned out your bedroom and moved it into somebody's storage facility. Not mine because we don't have any in downtown LA.
Well, I think for an asset allocation purposes, and we're going to talk about MSAs in a second as well, I can see why storage has become such an integral part. So Larry, let me move back to you. You know, let's stay on this COVID thing for a second. You know, the knife dropped. It dropped really deep. Offices got hurt. Retail got hurt. Different sectors of the economy really just got beaten up. Do you think the knife really dropped far enough from Q1 20 to Q1 22? Do you think there was enough shakeout that now we have a better feel for what's going on in hospitality or retail or malls?
Yeah. The even though, you know, retail and office got hit pretty hard, if you look at the multi-tenant retail space currently, that's actually doing very well. So that's more of an opportunistic play. I think a lot of people have bought online. I mean, e-commerce is still growing, but I think people want to get back into brick and mortar, and we're starting to see retail start to benefit, you know, from that shift back from e-commerce to brick and mortar. The office side, you've seen 3 to 4 quarters of positive net absorption on a national basis, although some of the markets like New York and LA and San Francisco and Seattle, those coastal markets that didn't open up soon enough, you know, haven't really seen the benefits yet, but you know, they'll be coming. Industrial, you know, is starting to cool a little bit, but it's one of the top sectors. You know, storage was one of the best performing sectors, you know, since over the last 2 years from a return basis. Apartments are one of the best performing sectors also just because of the demographic demand and the, and the recovery in the job
interrupt
market.
you right there, because really what you're talking about is repurposing. So Jeff Lerman, let me come back to you. I know that you are repurposing an office building right now. You've had this building, you and your partners for 13 years of ownership. You're now repurposing it. Tell us what caused this repurpose and what are you repurposing it to?
Yeah, so we have a mixed-use building. On the top floor we have apartments, and on the bottom floor we have our offices. And when COVID started, most of our staff wanted to work from home, and we've accommodated them in that. And we have only 3 or 4 of our staff actually in the office. And it's been that way, obviously, for the last 2.5 years. And so it doesn't really make economic sense for us, because we do believe that where we are right now is probably going to continue for another few years. And so we decided to convert our entire office floor to more units, more residential units. And it was something that the city was very much in favor of, because they need more housing. And so we're working with a consultant who they do ADUs, and they do things like this. And so they're helping us out, and we feel like the numbers, the profit is going to be quite a bit better for us when we do this conversion than just continuing to have a bottom floor of our building, pretty much only 3 or 4 people there instead of the 12 or 14 that we used to have.
Interesting. Well, let me pivot over to Jeffrey Leone. Jeffrey, at HLA Ventures, I want to hear a little bit more about your business model. I mean, I know that you are an advisor to United Growth. For those that don't know it, United Growth is a shopping center developer. You're an advisor, obviously, to Glen Coast. Glen is a multifamily developer. Are you open to more relationships like that with other family offices? Tell us a little bit more about your business model.
Sure. Thanks. So we have, alongside of our investor base, which we have about 90 high net worth individuals, families, and even some small corporations. So we acquire projects for our own account, as well as co-investing with a handful of project sponsors, as you mentioned. We've raised about $300 million in equity capital over the past 30 years. And we've had a pretty good annual average internal rate of return of north of 18%. So I think that we do like investing with project sponsors. I think it allows us to look at various product types and various geographies that we're familiar with, as well as investing in controlling our own destiny in terms of projects like retail, office, and apartments.
What do I have to have in sort of total assets under management as a family office? 50, 100 million to come to you and say, hey, I need you. I need an advisor. Is that something you would take on?
Well, absolutely. I mean, we have investors that invest as little as $50,000 a deal. So it can be $50,000, and we've got family offices that invest $1 million per deal. So we have a lot of investors, and each deal that we do is set up as a special purpose entity. We're not a fund, so the investors know exactly what they're getting, and they like that, as opposed to investing in a blind pool fund.
Well, let's talk about a fund, and let's talk about underwriting criteria. So, Deborah, let me come back to you. One, I want to hear a little war story about something that you might be working on right now. But more importantly, tell us about that criteria, that underwriting that you do, and give us some examples of some of the deals you're working on, because I think family offices really want to kind of get inside deal making and have a better understanding of what it is that, people like us do when we look at real estate. So tear something apart for us and, sort of open up that door. We'd love to hear more.
Thank you, Matthew. So for criteria, the family office really looks to a strong sponsor with an incredible track record, and also the general contractor. Look at their performance and track record. And net worth and liquidity is constantly an issue with sponsors that I see. The ones that come to us are just barely able to make that net worth and liquidity. test that it's a debt to net worth ratio 1-to-1, and liquidity being 10% of the loan amount, equal loan amount to be liquid. So that segue right into some war stories. We've got a project right here in Silicon Valley, and they're building ground up construction, mixed use. It's mostly residential units and office. So they have a lot of complicated and complex things going on with PACE financing, ground lease, limited equity investment by the sponsors. And
well, let me
so
stop.
we've crafted.
Let's dig into PACE. I don't think a lot of our investors know PACE. So talk about CPACE for just a moment, if you will, because I think PACE is an extraordinary way to get equity into a capital structure. I think PACE, is 15, 20 years. You can pass along, as you know, some of the PACE costs to the your tenants if you're more in a retail environment, like say a doctor's office. Tell us how you've used PACE in the past. I'd like to hear PACE, and I think you really need to sort of open it up a little bit more to explain to investors how PACE is used in a cap structure.
Right. Thank you, Matthew. Actually, PACE financing has become quite a bad word in our sector. So PACE, C stands for commercial, and PACE financing is basically a bond from the government, and it works like a property tax lien or your payments to be paid just like property tax and their assessments. So it's for investors who are both residential and commercial, where they are improving their property to make it more sustainable, climate friendly, eco-friendly. And so
right. No, I think
lenders
PACE
have not been
absolutely great place to be. And you're right. You have to talk to lenders and ask them one simple question: do you allow PACE in your cap structure? Some banks don't even understand it yet, and others are for it. So we're going to come back to PACE.
It's in first position. The CPACE financing is in first senior position, which scares the lenders, and a lot of lenders have backed off on that.
All right, I want to pick that up in a minute. Let me come back to you, Jeff Leone, and family office clients buying industrial properties. To tell us a little bit about what's happening in that sector, and more importantly, that cold storage we keep hearing about, that last mile. What's going on there, and is that still a viable place, again, that last mile cold storage for JV investors or just pension plans and family offices to put their money? What's happening there at the moment?
Well, Matthew, I can tell you, we're kind of a jack of all trades and a master of none. Unfortunately, we don't do a lot of industrial investing. We primarily invest in retail, office, and residential. So I can maybe, sort of talk to you about retail and apartment investing.
Sure, that'd be great. We'd love to just hear about what's going on in those two sectors, and what should family offices be thinking when they sit down with a developer who has ideas, they've got capital. What should they look at?
Well, so it's interesting that we have investors that really like the certainty of apartment investing. They get nowadays they get a current cash on cash return. They also take advantage of bonus depreciation, which is a newer advent that came up in about 2018, which allows 100% of the depreciation be taken year one and carried forward. So it's pretty attractive to taxable investors that can actually use the passive loss. And that is unfortunately phasing out over the next few years. This is the last year that's 100%, and it moves to 80% next year. So on the apartment side, aside from tax benefits, it's cash flow. On retail, which we buy distressed retail with clear path to repositioning, it's a bit higher risk. It's more of a flip and fix strategy where we plug in a tenant, mostly a grocer, and then sell the property off once it's fully stabilized. And we do feel pretty strongly that retail, the bricks and mortar, I think it was Larry that mentioned, I think it's going to be strong. I mean, the general retailers have been hit pretty hard, Target and Walmart as of late. Their earnings have not been good, but there's continued growth in the dollar chains with Dollar General and TJX. And then you've also got the expansion, as we call it, from digital to bricks. to bricks and mortar. So
Great
some of these
point.
specialty stores
Yeah.
include Warby Parker and Allbirds and Fiore. I mean, so they've been online, and now they're taking space in shopping centers.
Well, let me move over back to Jeffrey Lerman. So Jeffrey, I mean, your business model is so unique because you really care about your clients and they're coming to you for advice. Talk to me, and let's sort of position you. You can sort of talk about your firm a little bit. Let's talk about why a commercial law firm is essential for a family office or an institutional portfolio. Why are you such an integral part of what they do on an investment basis?
I can speak on that if you don't mind. I would. By the way, can you still hear me? Okay.
Great.
Very well.
Okay. I'd like to go back and talk about the joint venture because that really is the topic that I'm most passionate about. Can I spend a couple minutes on that, and then we can go back to that later?
Of course.
Okay. So when I speak to investors, this topic is the one I'm most passionate about because I believe what I'm about to tell you gives you more value than anything else I can tell you, because this topic can save you money, mitigate your risk, and help you grow your real estate portfolios faster than anything else. In my experience, the cheapest, easiest, fastest, and safest way to get deals done is with joint ventures. And again, when I say joint ventures, I mean the coming together of two or more people for a common business purpose, where all members are actively engaged in the deal and not just bringing money to the deal, and all members are experienced in real estate. And the problem with syndications are they're too expensive, too complicated, too risky, takes too long. And the main advantages to a JV over a syndication is JVs are less expensive than syndications, much faster than syndications, much easier to set up than syndications, and you'll have no worries about inadvertently violating securities laws. JVs also can help you diversify your risk, which is especially important given the uncertainty of the future. And JVs can also help you create a new deal pipeline with your joint venture partners. And we don't have time to go too much beyond this, but I'll just finish this particular topic with a short clip from a Wall Street Journal article where they wrote, and I quote, "A growing player in the real estate market is the so-called family office, in which an ultra-high net worth family, typically with more than $100 million in assets, joins with another wealthy family to buy investment property. Despite having ample cash, these families are looking for partnerships in order to lessen their exposure to risk. If real estate values were to tank, for instance, losses would be spread out over at least two parties rather than one family incurring the entire hit. And some family offices with expertise in housing look for partners that have built their wealth in other sectors. Others seek out real estate investors with a similar background in order to combine their expertise. Partnering up can help a family office get regional diversification. That way, if a market takes a turn locally, the families still have rental income from other locations." And so I just want to, there's a lot more. I usually on this topic, I can go on for an hour, but just to give everybody a taste of why this is something I really think that they should, if they're not already dealing with joint ventures, something that they should do. So, and if anybody would like a webinar on this, I can send it to you. Just send me an email at jeff@lermanlaw.com.
No, thank you very much. Well, let me pivot on, sort of the JV idea, and I'm going to come back to you, Ken Nitzberg, chairman of Devon. Let's talk about Kmarts. I know you love vacant Kmarts. I know that you can make money there. You're buying them cheap. You're basically getting 2/3 off the price. I would be afraid if I was an investor if you told me that, you're putting my money in a vacant Kmart. Explain to me why storage is perfect for a vacant Kmart.
Well, if for some bizarre reason one wanted to get into the self-storage business, there are three ways to do it. Two of them you can do with any kind of real estate. You can go buy one from somebody else, which I call the greater fool theory, because he's a fool, you're going to do better. The other way is you can build one from the ground up, which is very difficult because cities don't want us. They don't like us. Cities live off sales tax. We don't generate any. We don't generate any jobs like a strip center. So getting zoning changes and building permits can be a real battle in most communities. So what we like to do is what we call conversions. We like to buy vacant buildings that have gone dark. The longer they've been dark, the more graffiti, the more times the cops are out on Sunday morning to break up a meth lab or a rave or whatever, the more homeless camps there, the bigger the weeds and the more broken glass. All it means is the price is less. And if it's not to pick on Kmart, but they are my favorite company in the world. because every time you think you found the last vacant Kmart, you find 5 more. They're like cockroaches. They never go away. And we've converted a bunch of them. And Kmart, unlike Walmart, for example, never did own any of their own stores. They were all syndicated out to individual investors. And the investors thought hey, I got a 20-year triple net lease. This is bulletproof, idiot proof, until Kmart went chapters 1 to 200 and abrogated all those leases. And then all of a sudden they were stuck with this building. And the odd thing is the tax collector still wants to get the bill every year.
But wait, let me interrupt you. So this story is amazing, but I'm still a family office, I'm afraid. Get to the economics of why you
Sure. Well, the bottom line is if you want to build a self-storage facility today versus a conversion we can do and be all done and for about 2/3 the cost of a ground up. They look like a brand new building when they're all done. You can't tell the difference between a brand new ground up and one of our projects. You can get in about half the time and be open. And because you have a much lower cost basis, you can be very competitive with your competing properties rate-wise because you have a lower cost. So it's in my opinion, I'm biased as can be, it's the best way to go. And it usually lets us get better locations because I always joke, but it's true that storage is a retail business disguised as storage. You need to be on major retail arterials. The best sites I've ever had are on 6-lane roads, 3 lanes each way with stoplights every block. So people can see you all the time. 30 years ago, the driver was the cheapest land. So they'd buy the land behind the sewage treatment plant under the railroad tracks by in those days, homeless camp. Now hobo camps. Now they're homeless cities. If you build one there today, you'd never rent a unit. You need to be on major retail thoroughfares and they need to look like anything but your mind's eye vision of a storage facility. They look like office buildings, shopping centers, hotels, and have all the amenities to go with it.
I love what you're talking about. Let me pivot back over to Larry Souza. Larry, you and I talked earlier about repurposing vacant malls.
Matt, hang on 1 second.
Hold on, Matt.
Marty wants to jump in.
Oh, sorry, Marty.
So understanding, this whole thing with the, self-storage and where location matters a lot. Is there an undercapacity of self-storage? Too much capacity? Can you talk about like the general economics of that marketplace? I mean, it seems like there's tons of self-storage that's popped up in New York, for example, the last 20 years, right? Sure.
The exception of the boroughs of New York, which are a different solar system for our industry, typically 90% of your tenants will come from within a 3-mile radius of your location. So when we look at a location, whether it's to buy that vacant Kmart for pennies on the dollar, or a piece of dirt to build, or an existing facility we think is being undermanaged, we look in that 3-mile market to get the demographics we want. What's the competition? One of the standard measurements is what we call saturation, which is how many square feet of storage in that 3-mile market from all the competitors divided by the population. The national average is about 8.5 square feet for every man, woman, and child. If you look at Las Vegas, it's about 30 square feet per person. You look at New York, even with the new construction, it's really 0.5 square foot per person because there's so many people. So what you want to look at is the level of competition, the household income, all the other demographics you need, no different than opening a Starbucks, for example. And if the demographics work, and if we can buy that vacant building for pennies on the dollar, essentially the price we pay for those buildings is the value of the underlying dirt. And we get the building for free. And sometimes we can use the majority of it.
Any thoughts on Texas or Florida?
Well, we have, 15 sites in Texas and another dozen in Florida. Again, you can talk about certain cities being overbuilt. I mean, Houston is the classic whipping boy. Everybody hates it. We have 8 stores there. They're all doing just great. Because again, if you draw that 3-mile map and look what the competition is in there are holes. If you took, I don't know if any of you are familiar with Houston, there's a freeway that goes around the city called the 610. If you got on it at 8 in the morning and there was no cars, which will never, ever, ever happen in Houston, it'd still take you all day to drive around the city. It's the 3rd largest landmass city in America after Jacksonville, Florida, and Juneau, Alaska, because Juneau's the whole state. So if you take that, everything inside the 610, blow it up to a map the size of the screen there that Matt's picture is on, and draw little 3-mile circles all over the place that touch but don't overlap, you're going to have 30 or 40 that are way oversupplied, overbuilt. and you're going to have several hundred that are underserved, and you're going to have another 500 that don't have a single facility in them. So location isn't important. It's drop dead critical.
Got it. So, all right, let me get back over to Larry. So Larry, talk about repurposing.
Matt just took off again. Matt, we got a question from the floor.
Oh.
We do.
He's going to get upset.
Yeah, keep on going, Sal.
All right.
Sal.
So anyway, history has shown us that cheap capital supports the biggest solutions. And in your industry, there was a lot of newer entrants who came in.
Sure.
Doctors, right? They know the signature loan. And they're sort of outbidding the smart people like you. How are you preparing for interest rates? Should they happen to continue to rise? You see opportunities with retail mom and pop guys, but operators didn't know they were going to go where probably have some sort of a senior debt product on it that might blow up. Is there opportunity?
Repeat the question first.
If I can. Sal went on for by 5 minutes. Basically, if interest rates go up, can we still compete? Is that the gist of what you said?
Stress because stupid people plowed into your business.
Oh yeah.
Self-storage has a low, it's a lower barrier to entry.
Exactly. Exactly.
Is there an equivalent to the hedge fund guys investing in venture capital?
Yes. Yes. I mean, if you look at our industry, there is approximately, nobody knows for certain, between 55,000 and 60,000 self-storage facilities. And they range from public storage, which is the 5,000-pound gorilla in the corner with 3,000 stores and a market cap of 70 billion, Fortune 500 company, to a mom and pop kettle that have 6 units, in Nosepick, Arkansas, and everything in between. But you get below about the 50 largest operators, and it's all mom and pops, very unsophisticated. The REITs, the 5 big REITs, don't build anymore. Public does a little bit, the others don't any. So the growth in the industry is from the mom and pops adding a store here or there, or speculative developers who think it's an easy business. And we have a lot of dumb money coming in, and I love them because they come in and the pro forma says that in 3 years, they're going to be 90% leased and getting $1.50 foot in rent. And what happens in 3 years, they're 40% leased and they're getting 80 cents and they're upside down on their loan because they overfinanced it. And I get to go buy it for 40 cents on the original dollar. And I've done it in 4 turns. Yeah, bring them on. Bring them on.
Thank you. All right. Let me take back control. Let me move over to Larry. Larry, can you hear me? So, we're staying on a great theme, which is repurposing vacant retail malls. Let's talk a quick second about, acquisition costs, months vacant, zoning, and how does that play into how do you repurpose?
Zoning is the biggest issue. Because again, if the site's not already zoned for storage, and that isn't very often, going to the planning commission, the zoning board, the mayor's redevelopment office and say, I want to put a storage facility in the corner of Main and Main in your little town. And they go, you want to do what? We'll do that as soon as pigs fly through town. It's a very much of an uphill battle. We win about 60% of those battles. You don't win every one. Nobody bats 1,000. So, but that's where we make our money, by buying the vacant asset at the right price and converting it and filling it. So we have a much lower cost going in. We have 15 sites right now around America under construction that are all conversions. That were all something else before. I think 2 of them are Kmart's, but the rest are everything else.
So Larry,
are any of you familiar with Boston?
Can you pick up?
I don't know who I'm talking to, but the Boston market, heard of Legal Seafoods, which is the seafood restaurant in Boston? We bought their old fish processing plant on Mass Avenue right off 95. They closed it, they abandoned it, and built a new one. It was vacant for 7 years. And we bought it for next to nothing. Took a while to get the fish smell out and all the feral cats. Converted it to a storage facility, filled it, and sold it at a humongous profit. And it's now an extra space self-storage, the 2nd largest REIT. So it doesn't have to be a Kmart. It just has to have the right demographics and the right price.
Gotcha. Larry, try and jump in there and cut, if you can. Talk to us about repositioning vacant malls. Tell us a little bit from an economist view what you see.
Sure. I mean, you're going to have to work with the city, to be able to get the zoning to do mixed use. You would think that they would be wanting to expedite the process on the entitlements for an adaptive reuse and mixed use because a lot of their tax base is tied to the retail sales. So if there's a bunch of mothballed, underperforming retail shopping centers or malls, you would think they would want to work with the developers to expedite the permitting process to allow for the mixed use to bring back the tax base. They're going to have to do that. They're going to have to modify the zoning. They're going to have to work through the planning department, the building department. They're going to have to go to the voters. There's a lot of political rigidity there to be able to reuse these retail. You are seeing office REITs, particularly Kilroy, Boston Properties, some of the others start to move into life science as an adaptive reuse in some of the obsolete office buildings. And then there's obviously, if you can make the office buildings pencil, to change them to residential, if you could actually make them pencil, again, you're going to need city support, zoning, planning department, and you're going to need developers that are comfortable transitioning office use to residential use.
So, for the family offices that are listening here and the pension plans and those high net worth investors, you can see doing it by yourself is so difficult, and why the individuals we have paneled today are so important and key to your portfolio. And to that idea, let me go back to you, Jeffrey Leone. Talk a little bit about what you might see in Q4 22 or even in, Q1 or Q2 of 23. What do you think the breakout star is going to be? What asset class?
It's a good question. I think residential will continue to bloom, notwithstanding the fact that interest rates are rising, and that which compresses your cash on cash returns. I think there are rising rental rates that'll offset that interest rate increase. So I think residential, and there's also a shortage of residential development across the country, as I think Jeff Lerman mentioned. There's been increasingly a push toward building ADUs. I know in our county, there's a lot of towns that are waiving planning requirements for ADUs. So I think residential will be a darling. I think retail will continue so long as it's necessity retail. I think that will continue. I think there's, on the flip side, I think there's a lot of uncertainty, and especially in big cities like San Francisco, the hybrid work model is becoming more and more popular. And the question really becomes is that can be something that's really adopted? I can tell you that just last week, a 50-year-old law firm, Farrell, Braun & Martel, they had 140,000 feet at the Rust Building, and they basically gave it up. They're going to consolidate into 40,000 feet. So that's just one of many, and I think that trend could continue for those adopters.
Wow. Deborah, let me switch over to you, and let's just stay right on that topic. How do we deploy capital, and into which asset classes, Q4, Q1 of next year? What are you thinking?
I would, bar none, say residential multifamily. We are about 4 to 5 million units short of demand. So builders can't build fast enough, especially in this post-COVID environment. I do want to piggyback on the other comments on retail. Retail is such a huge area, huge sector, and specifically shopping malls and centers. I don't know if anyone knows this, but for 21 years, we have not had any new shopping malls developed. I'm talking ground up construction. So it's astonishing. One of my good friends is, I would say, the most legendary and national expert in shopping centers and malls. And so he has a mandate to take care of 185 of these. These are coming down from the pension funds, institutions, the lenders that are stuck with these malls. And his sole function is to figure out how much to write them down. So it's really scary. And he has brilliant ideas on how to reposition each and every one, because each and every one has their own fingerprints. And a lot of it is going towards mixed use and just getting that right mix, what percentage of each area, whether it's multifamily or office or retail, just the right mix. So he's incredible. So I'm getting a lot of my inside information from this guy. So I would say
I think
hospitality is going to be hurting still
Yeah.
for many years to come. But the family office that I work with, we love multifamily, and based on their experience of developing hotel, hospitality, resort assets over decades, they love and understand hospitality like nobody does in globally. So those are their two favorite asset classes, and they know. I mean, they were the only ones that were funding hospitality construction during 2020 when nobody would touch those. So it's going to take a while, but it's slowly trickling back, and it'll come back strong eventually.
Okay. Well,
Thank
Jeff
you.
Lerman, let me ask you a question. I mean, you can, pick up from where Deborah was, but where I really like to lean into is the social aspect. What about workforce housing? What about, helping those individuals that are earning, say, $100,000 or less? They're police, they're fire, they're, more blue line workers, but they need housing. How do you get somebody out of rental into ownership? How do you help that individual, and what kind of an asset do you build?
Well, that's the $1 million question right now, because so many people, not just those people that you mentioned, but just millennials. I mean, we've got our kids, and we're living their the problems that they're having trying to find something that they can afford. So it's a real problem. We've got prices continuing to go up, and they will continue to go up. And it's really doing nothing for the people who can't afford it. And so that's why also apartments are continuing to be strong, because that's what most people have to live in, because they can't afford to buy a home.
Do you think the social aspect is going to be helped or hindered by the local communities? I mean, they all know that they've got a rental problem. Do you think that they'll lower some of those barriers to entry to, say, builders to allow, say, a mixed use of market rate plus, workforce housing to put up an apartment building? Do you think there'll be more help than the cities?
It depends on the city. That is already going on in a number of cities, but it's certainly not. I don't think it's happening throughout the United States. I'm sure that it's not. So it is a problem. It's a huge problem.
Right. We're feeling it here, obviously, in Los Angeles and Pasadena and, out in the Valley. And let me switch back to you, Jeffrey Leone. You and I talked earlier this week about the psychology of investors, behavioral finance, how investors pivot from soft assets, like, say, stocks and bonds, into hard assets. How do you get that guy who comes to you with a really big portfolio, and he's very liquid and he's in the market and he's got cash, to think about 7 to 10 year holds, or maybe 10 or longer year holds? How do you get that guy to make that change? You're muted. You're muted. You're muted. Oh, still muted.
Jeff, you have to unmute.
Yep.
There you go.
Sorry about that.
Okay.
Yeah, it's a good question. That's kind of our job, right? But I think there's been a lot of investors that have generated alpha in their individual portfolios by investing in high-flying tech companies. And unfortunately, that hasn't worked out too well in the past 6 months. So we're seeing a lot of our investors pivot toward putting their fresh cash into commercial real estate, especially commercial real estate that cash flows. And that goes back to multifamily. So they're becoming a little bit less risk adverse unless there's a clear path to a repositioning strategy.
So pitch me on whatever deal you're working on now or is on the drawing board. How do you get me in?
Okay, well, we're buying some apartments up in suburban Olympia, Washington. Day one, you're going to get a 6% cash on cash return on your investment, and for every $100,000 you invest, you'll get a $60,000 passive loss year one. So when you put both those together, the returns are pretty attractive, especially for a tax-paying entity. The vacancy in the areas less than 3%, no new construction on the way, and there's a lot of room to run on rents. So there's an employment base. Amazon's down the street. Sure. and growing.
No, really good pitch. Okay, just tell me where to send my check. So, Mr. Souza, let me go back to you, Doctor. Let's talk about AI, like so artificial intelligence in terms of the way that it's changing the commercial real estate sector. There's so much here for you to chop. So try
Sure.
and keep it short and keep it tight. But I'm thinking loan modeling. I'm thinking technology for broker versus bot. I'm thinking, population analysis, logistics, search,
Sure.
negotiations. Tell the family offices and pension plans how they should be thinking about how AI should come into their portfolios or is changing the way that they'll get more alpha out of their portfolios.
By the way, we have about 2 or 3 minutes left.
Take it, Larry.
Okay. Well, one, you could take the risk and invest in these startup companies, prop tech, fintech type companies. That's a different risk spectrum and different appetite. You can look at how the technologies are being used for building efficiencies. That's going to be, if it lowers the cost of operating the building, that's going to be organic growth, in the NOIs. And then what we've done, with our tech company is to be able to create new investment strategies. We built 2 products, a smart beta product using the technology and using that investment strategy, using REITs to expose it to the underlying real estate market. And then we built a machine learning application to create a investment strategy that's alpha generating to be able to invest in the REITs, buy and sell the REITs, over the investment time period. And that was able to generate alpha that way. So it could be operations, could be investment strategy, could be managing your data more efficiently using big data applications with the AI and the ML. There's so many things going on, but it's happening very, very quickly.
Thank you.
You really need to be on top of it.
Thank you.
Decide where you're going to put your money and how you're going to.
Marty, if you'll give us an extra minute, I'm just going to ask each one of our panelists to sort of have a nice, short and tight closing statement about family offices and investing in themselves. So, Mr. Lerman, why don't you take the first crack at it and just keep it nice and tight and just close up for us, and we'll move around the circle.
Okay, well, the one thing that I didn't get a chance to talk about that I think everybody would like to know about is a different approach to letters of intent. And so, again, if anybody wants to save money and use your letters of intent more effectively, send me an email and I'll be happy to explain more.
Thank you very much. Jeffrey Leone, closing comments, things that pension plans, family offices should be thinking about, or just something about your own firm that you'd like everybody to know?
Sure. I would say, in this kind of day and time, to make sure that you invest with a sponsor or investor that has a good track record, solid track record, and that has very conservative underwriting, because we are headed in choppy waters. And unless you take those types of things into consideration, I think you're putting your money at risk. So we're very conservative, and anybody you invest with should probably do the same thing.
Really well said. Deborah, some of your closing thoughts on your firm or yourself, or just, family offices and ideas. Please keep it short and tight. What are you thinking?
Yes, I just want to hone in on what's happening in the industry. Again, private real estate lending and debt funds really have blossomed as an alternative investment. And, with the likelihood of post-COVID credit tightening, this will increase even more this market for private lenders and construction and bridge loans, especially of 30 million plus size, which are really rare among the traditional lenders. And so our family office average loan size is about 125 million. Thank you.
Nice. Thank you very much. And Larry, things that you're thinking about that, economics wise, Fed watching wise, interest rates, family offices should really maybe look at every day or every week, and things that are going on at your own firm that we should just be aware of. Again, keep it tight, keep it short. What are you thinking?
Well, I think one of the greatest things, over the last, 5 to 10 years is there's so much really good information out there these days. CoStar does a great job, Cushman Wakefield, CBRE, Jones Lang LaSalle, Marcus and Millichap. There's such great research, out there. If you can, get to somebody, like myself, who can synthesize a lot of it and then create the strategy around it. And then either, working through me on the solution or working with your service providers. And then, like you were saying earlier, Jeff, working with the right sponsor that's transparent with a track record, so you can really feel comfortable with their investment strategy, and they can execute, and they're a good fiduciary at the end of the day.
Really well said. So Ken Nitzberg, I'm going to let you sort of close the show and tell us a little bit about, what you're thinking investors should be, cautious or optimistic about when they think about storage as a sector.
Well, when it comes to the storage sector, I think that a family office or a pension fund should very quickly figure out they can't do it on their own. It's too much of an operating business. There's too many little tiny moving parts that can trip you up. You need to find an operating partner that is knowledgeable in the business and has a record of dealing with institutional or high net worth family offices, and not just their three buddies they play golf with on Saturday, where the quarterly reports are written on one side of one piece of paper and the financials are non-existent. And we've all seen that. So I think that's critical. The other thing I just wanted to mention is one of my favorite pet peeves is everybody's discussion of cap rates. If you give me a P&L for a property, be it apartments, storage, anything, and tell me what cap rates you want, I can prove it's there by what you count or don't count. We get packages from brokers selling existing sites with great cap rates, but they've taken all the expenses out.
In the reserves.
We bought a facility in Spring, Texas a few years back, which is right across from the Woodlands, just a little northwest of Houston, downtown Houston, run by a Korean family. And the cap rate, if you looked at it, was about 4, because they ran their car payments through it, the kids' tuition, mom's beauty treatment salon. So when you strip all the nonsense out, we bought it at a 7 cap. So when we look at a deal, we look at replacement cost, we look at the ratio of rents that we can obtain versus the price per square foot we're paying or building to. And cap rate is an interesting academic consideration, but in my world, it's pretty secondary, maybe tertiary.
Very well said. And I think the family offices understand exactly where you're coming from. So my good friend, Marty, we're going to give the program back to you.